Hi, this is Patrick Adams with this week's Market in a Minute. We think the Federal Reserve's done raising rates. We'll know probably on May 3rd when they have their next announcement for sure, but we think that the data coming forward, plus the fact that the two-year Treasury is so far below the federal funds rate, that the Federal Reserve will be forced to stop raising rates. They're causing some major problems in the banking sector, and the bond market is clearly saying to the Federal Reserve, stop now. Looking at the U.S. Treasury bond versus nominal GDP, this has always been a very reliable indicator. This is 73 years of data. You can see how well these two correlate. The red is the 10-year U.S. bond yield, the blue is nominal GDP. They're not always exactly the same, but they correlate. So meaning if one's going up, the other is also going up. If one's going down, the other goes down. So if you look at where we are currently, the 10-year Treasury is roughly 3.5% to 3.4%. The last data point on nominal GDP was 6.7. So we think that nominal GDP is coming down. The bond market thinks it's coming down. Otherwise, the yield on the 10-year Treasury would be much higher. So there's two components, right, to the yield on the 10-year Treasury, how it's made up, and also nominal GDP. So nominal GDP is real GDP plus inflation, and that's what comprises the inputs into the 10-year Treasury. So we think that the real GDP is probably going to be flattish to down as we go forward this year, and inflation is going to be coming down in a major way. And I want to walk through the components of inflation and why that's occurring. First, we have the personal consumption expenditures index to be reported on Friday. Now, the last report, this is what the Fed likes. The Fed likes this particular inflation barometer. Now, the last report was up 5.4%. It was up higher than the 5.3% on the previous month in December, and we think it's going to be 5.1% or potentially lower. And as we go through the year, we think that the PCE is going to drop pretty significantly. It peaked out in June of last year at 7%. So we're going to look at some comparisons of the inputs into the PCE from June of last year. Here's the PCE, the outer band here, and on the inner band is the CPI. So you can see that there's a lot of similarities. There's some differences that are notable. Housing is a little bit lower of a component of the PCE. It's about 33%. Housing prices have been coming down. I'll show you that. They're down about 12% from June. Food and beverage, about 17%. It's actually trending up, but it's starting to flatten out. And then transportation, this component could be down pretty significantly. So those three are about 2/3 of the PCE and about the same as the CPI. So the components, existing home sales prices they were up about to $415,000 per house. Now they're down close to $365,000 per house, or a little bit lower than that. It's down approximately 12% from the June level. So housing prices are definitely coming down, and that'll affect rents on apartments. So we think the pressure from the housing, which has been really strong, it went up about 42 from the bottom in 2000, 42%, is starting to roll over. So it's not good for housing prices. Secondly, now this is the transportation part of it. Transportation, oil prices. Oil prices are down 43% from the high. Unbelievable that they got to $120 a barrel. We do like energy as a play, but not exactly now. But over time, over less than 1 year, we've had this roughly 43% decline in oil prices. So that's a big component of the transportation component of PCE and CPI. Now, the used cars and trucks down quite a bit from June, down 12%. So that's another big drag on inflation. And then lastly, food and beverage is up about 5% from June, up about 9% over a 12-month period. We think is starting to flatten out. So we'll see that trend going forward. But if you go back and you look at the major components of inflation, housing down 12, transportation, I'm not sure exactly, but say it's off 20%, and food and beverage up about 5%. Things are slowing or rolling over. So the Federal Reserve does not have to be aggressive at this point. Things are naturally coming down as the economy is probably maybe slowing more than most people realize at this point. The bond market's caught on to this, obviously. The stock market maybe not so much. What to do in this environment? So here's our roadmap. We think there's a trade here. If you look at the charts, the blue is the S&P 500, as you know, down over roughly 25% from high to low. It's meandered its way back up. We think there's a knee-jerk reaction to the Federal Reserve being done raising rates. That'll come in May. But we think the market will understand that this is occurring, and we might have a reasonable rally from now until maybe June or July up into this 4,200 area, or maybe a little bit higher. So that's a nice move. It's about 5+% move from here. And then we think that with all the negatives that have built up and all the resolves to all those issues that we've been thinking about, that there's maybe more bad news that the market is not currently discounting. So kind of the bear case of what's going on for the S&P 500 target is $200 in earnings for the S&P this year at a 15 multiple gets you about 3,000 on the S&P. So that's a significant drop from where we are currently of about 25% still. If you look at the bullish case, looking out to 2025, it's not a stretch to think that we're going to earn $250 on the S&P 500, and where the 10-year Treasury is currently trading, say trades around 3%, that'll get you to about 5,000 or 20 PE multiple, about 5,000 on the S&P 500. So if we do get this decline in the markets, there's about a 70% return from that low point up to about 5,000 a couple years out, and maybe potentially higher as time passes, depending on the policies from Washington. Now, why we think this will occur? Well, if you go back and look at the last major bear market we've had, it was 2007, 8, and into 2009. You can see the peak of the markets here in 2007, roughly a 50% decline until early 2009, followed by 5 years to get back to even, roughly 5 years to get back up to here. How we look at it is we don't have to take this pain. Our strategies can sell through here. So we have a proprietary technical algorithm that starts to get defensive as we break these moving averages, and to be completely out as we go through the 200-day moving average, and then to start to buy back in very early in the recovery so you get the benefit of this big rally. So in 2008, the strategies I was managing, the more aggressive one was down about 5%. The less aggressive one was up about 2%. And then how we do our algorithms, we can capture this major return here. So how we are thinking about things is we can play this market rally. If it doesn't hold, then we're out. We can protect our portfolios. We can hedge out the risk. If it does occur, we can make 5 or maybe 7% from this level, have a decent return for the year, maybe higher than what you would receive on cash, and then set up for a major decline like we saw in 07, 08, potentially. We put maybe like a 25 to 30% probability on something like this occurring, but there are a lot of negative issues, and we're not really sure which ones are going to impact the market in a big way, what will actually occur. But this pattern here that we're currently seeing is kind of like an extended pattern that we saw during this period here. you know, there is some volatility trying to hold in. There's a big, nice rally here, and then ultimately it fell. So thank you very much. We appreciate you listening to our video. If you'd like to receive our weekly research piece called Market in a Minute, go to my website, Patrick Adams CFA, and put your information in, and we'll send that to you every week. Please hit like on the video, subscribe, so you can get the video update on a weekly basis as well. Take care.